crude oil prices briefly topping levels of $130 per barrel. That's a 13-year high on the possible Western ban of Russian oil. Let's connect with Priya Misra as well as Jonathan Barratt, who join in on the show right now. Thank you so much for taking time out. Jonathan, I'm going to begin with you. Given the kind of precarious situation that we're seeing with crude oil prices as of now, what is the outlook when it comes to a complete, a possible Western ban on Russian oil, and how imminent would that be?
Oh, look, I think let's see how things escalate, but certainly very tender hooks at the moment. If that was the case, remember, Russia is a major supplier of oil and we don't have a lot of spare capacity in the market. So I would think that, I think if they did that, that is a concern. Obviously, we are at those record highs, and if prices continue to move higher. Russia is important to the global economy, not only from the oil perspective, the natural gas perspective, and coal's perspective. So there's a lot of things riding on at the moment. But if they did decide to do that, the West needs to find areas of where they can get their oil in terms of to keep any momentum we've got in the economies up and running. So yes, a bit of a concern at the moment, no doubt about it. I feel that they won't act. I think they'll look for other methods to curb what they're looking at.
Would you tend to agree, Priya, that as of now they perhaps won't act because as of now, even the steps that the West has taken, they've not completely isolated Russia from the global economy, and these steps would tend, lean toward that?
Right, absolutely. I think, the war itself is a stagflationary shock to the world economy that was already grappling with high inflation, which is why I think so far the West has been careful about the oil embargo. But, the longer this continues, the more humanitarian crisis it becomes. I think there is a chance, though, that that oil will be included. And then really we're dealing with high inflation. At some point it starts to hurt growth. And also, I think, central banks are trying to step away from accommodation. So you've got the consumer that's going to be dealing with higher interest rates as well as higher prices. And higher commodity prices. So, I think it's adding to the downside risk to the consumer. And that's really why I think governments have been trying to not take it to that far. But, we're increasingly thinking that the chance of this becoming broader is higher than 50%. So we do think that, oil could be included in this, which is, just going to add to the pressure to the consumer.
Jonathan, we're already up about 25% in just the week gone by in oil. We're already at elevated levels of 130. Is there merit in even discussing where oil is going to go next? I mean, there are already reports citing 150 and 150 plus already because, the damage is already done. But how much more of an escalation can one expect? And I mean, at these elevated levels from 130 to 150, does it even merit any discussion here?
Well, I think let's put it this way. I mean, we only have to look back 12 months to where oil was, and we even went into a negative sector, a negative price. And we're seeing the demand and the COVID demand sort of push things up. So at these levels, I think the concern that we would have is sustained price levels sort of above that 120, 130 level if they get there. I think can happen as we saw when the market was in reverse and on the downside. So, but I would like to think that the economy, the global economics, or the people that make it up will make the right, because there's not some economies we know with Japan imports, India imports, all these other workhorses, all these other economies that require steady prices of energy. If it starts to wane, then I think everyone's got more of a concern. So I think common sense will prevail here. And if we have a spike, then I think it'll only be temporary, because I don't think a lot of economies can wear sustained prices of energies at these levels. It's super, super inflationary, and we already know that.
Priya Misra, I don't know whether there's a resolution in sight and where the entire Ukrainian and Russian peace talks are going to go and whether or not they're going to happen in the first place or not. But that said, just wanted to understand from your perspective, from a larger scheme of things, Jonathan was just talking about as to how coal, natural gas, oil, they all tend to get impacted, and we're already seeing that play out with this war between Ukraine and Russia. Can the world really replace the supply of these fossil fuels from Russia? Are there any alternatives that one could see the world replace from the Russian imports and maybe stabilize the kind of escalation that we've seen in some of these prices?
So I'd say in the near term, it's very hard to see where that replacement comes in, and ultimately there will be a replacement. The question is at what price, and which is why I think these prices are going up. And it's not just fossil fuels; it's also potassium. It's potash, it's fertilizers. It's really across the board. It's a highly mineral rich country, both Russia as well as Ukraine, and so the impact on commodity prices across the board, food prices, is going to be higher. I think there's also the question of sort of what we're calling informal sanctions. There's sanctions, and then there's people pulling away, or companies stepping away from the region itself, either because for moral obligation or of the risk of operating there, and which is why I think the market's pricing in these higher prices across the board. And I think that's there's sort of, we think it's going to get worse before it can get any better. Even if there are peace talks, we don't think that they're likely to yield a whole lot of results. And so I think that's why the market's pricing in this risk that this can continue much longer. It's going to keep prices on an elevated path until there is a reduction in demand, which then will ultimately reduce the need for these commodities, and that's where there'll be a market clearing level. So it seems like the path of least resistance is higher prices across the board, and in an uncertain environment where you don't know when demand will decline as much and demand is less elastic. I think this is why the market's treating this as such a big stagflationary shock, and we really have to see what is the response from other policymakers. Can there be fiscal response? I think a lot of focus is coming on the central banks. I would actually argue that there's more on the fiscal side. Can there be subsidies from governments that can buffer some of this shock on the commodity front? And we haven't seen as much. Europe is much more, I think, exposed to this. We haven't seen much from the European side, but I think that's the next step. Do we get any fiscal help? And that'll alleviate some of the pressure on the monetary side. So now I think short answer to your question is there's no direct way, I think, for this supply to be offset, which is why prices, I think, are likely to keep going up.
Makes sense. Okay, Priya Misra as well as Jonathan Barratt, great to have you both on the show. Thank you so much for taking the time out and speaking with us today.